Okay, the market finished the week on a really quiet note, very, very small range. We got the near-term pullback that we were looking for this week. Now, what are we going to get next week, right? That's what we're going to break down in today's video. We're going to take a look at the technicals. We're going to look at some timing and elements. Of course, anything can happen. But just to try to get an idea of expectations of how this next leg higher on the market is going to look. So we're going to break that down. We're also going to take a look at sector rotation and what to expect. What sectors have performed up to this point, what to expect going forward, and how to make a long-term trade on a stock going forward with the options on it. That gives us a lot of flexibility to add to our return. So let's go ahead and get started. Today is Friday, June the 14th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. So again, just like yesterday, some sound issues here at the beginning of the video, but keep in mind just right after this segment is over in the next few minutes, the sound resolves itself and it's back to normal again, and we'll look to get this issue squared away for next week. And I appreciate your patience on that. All right, well, let's start off taking a look at the market forecast indicator here on the S&P 500. And so you see, again, another really flat day today, 14-point range, 15-point range over there, and the blue tag right here, relative to 32, so below half. Very, very typical summer day. We're still above the moving average, but the moving average is still dropping, just a smidge, about a point still. So it's not going to turn green yet. We still have the dark green shading with the intermediate line rising above 50, so that's good. And the near-term line has turned back up above 50 now. So now, again, the expectation is that we will move up 7 to 12 days. So this is what we need to have happen. If we're going to maintain this bullish posture, which is the expectation, right, until it doesn't. So for that to happen, the blue line's got to get above 80, and it's got to stay above 50 for 7 to 12 days. Those are the two things we need to see now that it's formed this bullish low point. It's a much higher low compared to the previous one. I can probably get rid of this now. It's a higher low compared to the previous one, and the low point spent 3 days below 50, right inside the 1 to 3 day range, and it stayed above 20. So that's a good bullish near-term low, and now we're bouncing. Probably would have been better to come down more over just like 1 day or maybe 2 and then bounce, but this really sideways action is what's brought it and kept it down, and now we're bouncing up higher. And like I said before, the intermediate line's up above its market sentiment line, and it's making its way, as you would expect it to, from extreme low levels with the cluster all the way back into the upper reversal zone. So that's the expectation. You can see the Dow Jones Industrial Average looks very similar, so that's not surprising. The NASDAQ Composite also, its intermediate line is finally crossing above its market sentiment. Not nearly as bullish, so the near-term line hasn't popped up above 50 yet. So 3 days here below. And then finally the Russell 2000, not above its moving average either. In fact, you can see we were above it yesterday, and we got down back below it today. So that moving average will actually turn red again on Monday. The momentum line fell, but not to an extreme low. And technically, I got asked this before. How come I didn't mention intermediate confirmation signals when the momentum line dropped here? Because the intermediate confirmation signals with the bullish posture are better when the intermediate line's above 80. So they're weak enough when we're below 80 that I don't really consider them too much. When the intermediate line's below 80, and that's what we're seeing on the Russell. Yeah, we got an bullish intermediate posture, but not only is the intermediate line not above 80, but it's also not even above 50 yet. So. But its near-term line is above 50, and we'll keep our eyes. We're already up to higher highs compared to the last near-term peak, so that's what we're watching for. So it's been lagging. It lagged today, down more today, coming off of the last couple of days' gains, down more today. And so the postures on all these indexes remain bullish. We are towards the beginning of these bullish runs, so that's where it's a little bit more tenuous, right? That's where people are a little bit more concerned about whether this actually is an intermediate rally. And of course, again, you expect it to be until it isn't. And signs that you see that will tell you that it's not is when either the momentum line drops to an extreme low below the 5th percentile, which we haven't seen on any of these indexes. And secondly, when the near-term line falls below 20, and that didn't happen either on any of these indexes on this recent near-term pullback. So we expected the near-term pullback this week. We got it, and we got a bullish near-term pullback. Now, next week, the expectation is the near-term line will bounce above 50. It already has on the S&P. It still needs to do it on the Nasdaq, or excuse me, the Nasdaq and the Russell's already above it. So it's already, the Nasdaq's the only one that hasn't. Now that it is above 50, we needed to get above 80, which means we'll probably get a good start to next week. Again, news can throw any technical analysis out the window over the weekend, but those are the expectations. If, for whatever reason, that near-term line comes back down below 50 without getting up there in the upper reversal zone, there's a sign of weakness, right? There's a sign that we're not going to get what we expect. And if it follows that up with a dip down below 20, then we're pretty much done at that point. And the intermediate line rolling over from here, without producing that run up to 90 and even for that matter, even above 80, that would be a really bearish, So at some point in time, we can be more bearish on the markets. And I just showed you the patterns that would tell us that. Until then, we expect that it will behave like it normally behaves when you're in a bullish trend like we are right now. All right, so just like yesterday, we got that sound issue worked out, looks like. Before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here on the right there in the bottom right corner of our screen, then hit that red subscribe button that pops out. Or you can hit the red subscribe button right down below the video. Either way, that will notify you when these videos are posted. Also, hit the thumbs up icon down below the video. That lets me know that not only did you watch the video, but you got something out of it, you liked it, and you want me to do it again on Monday. So, quick and easy way to give us feedback about the video. Comment on the video and anything that did stand out to you down below. Also, join our daily Market Outlook email list. We have an email that we send out every day. There's a link up there. Very easy. Click on that link. It's a very easy way to subscribe to our list. Follow me on Twitter for more content. I posted a few things out there today, so make sure you're following me on Twitter to get that. And then finally, join our Market Outlook community that we created on Facebook. All right, we also invite you to subscribe to our website at marketscholars.com. Very easy way to do that. You can do it for free. If you're watching our video here on our blog, just right above the video to the right is Market Scholars. There's our tab. And again, you can really get to our website easy, marketscholars.com, and then hit blog, and you'll see today's Market Outlook post. And you'll see all this information here. But just subscribe to our site, click that there, a very easy form to do that, and that allows you to participate in our forums with other market scholars, and particularly in our Market Outlook forum. Of course, our class forums and our class schedule are for our premium subscribers that we have, as well as other features that are specifically for them on our site. But you get to participate in our forums as well as any of the free content that we put out there from day to day. Also, we invite you to engage with us on social media. You can see, my Twitter account and my Facebook page. There's the links that take you to either one of those. It's my LinkedIn. But in order for them to push you our content, especially with all the other people you might follow on those accounts, you have to engage with us. We try to make it really easy for you to do that. Just click this heart that will like today's Market Outlook tweet. Hit like. Excuse me, right there. Hit like. And then you can click on this image, takes you to your Facebook page. You can takes you to today's Market Outlook Facebook post, and you can like and share that there. The more you do that, the more, especially Facebook, will continue to show the stuff that I put out there, not only on my page, but also in our community that I told you about joining earlier. All right, back to the charts, and there's our long-term chart. Very, very small range. A lot of people talked about, it's a very small range, and now we're not going to be bullish anymore. Keep in mind that, and as I mentioned before, we had a 156-point range last week, and then we had a 36-point range today. So you're looking at almost a 200-point range, 100-point on average, and the average right now, the ATR for the weekly chart is around like 75. So put those two together, and that's a pretty average range. So not surprising after such a big week that we follow it up with a smaller week. And then we'll probably start to ramp up a little bit more and have a little bit more of a range. But as I showed you yesterday, and as we finish up this really short week, or really a small range for a week, that was a very bullish candle. So it's our first bullish candle. You can kind of get an idea back here. The week of 1.7 and 1.14 were the first candles over there. If I were to go back to the regular chart and look at there's the week for 1.7, and so that was even a relatively smaller compared to the 94-point range the week before, and the 173-point range and the 192-point range. We had those 2 weeks. So 70. I mean, it's not 35, but it's much smaller than what we had seen, and this one was a 156-point range. So that's how these, once you get the turnaround, especially when you're below the 200-day moving average, and you jump all the way through the gap and above the 50-day moving average, it's hard to maintain a strong follow through. But doesn't mean that we can't, right? Even if we maybe pull down a little bit more early next week and then bounce, either way, the expectation is, according to this chart, is that we'll get some more bullish candles coming out of it. The typical runs 1 to 3 months, so we're looking for 4 to 13 more of these bullish candles, and this was number 1. And now that we've had the transition candle here on the weekly chart, let's take a look at the 3 green arrows chart. Again, we have 3 green arrows. We don't have the rising moving average yet, so we have half the bullish pattern. We have the Steph Curry, but we don't have the Klay Thompson anymore, right? So we need to get that moving average rising before the train leaves the station. These are some lines that we talked about earlier today in my premium technical analysis class that I have for market scholars, talking about how the trend forms because of the smaller VIX, lower VIX that we have right now, and how things rally. We're not going to rally like this again. That's what this line is if we rally like this off of that low, off of this low, that's what the move would look like, and we're just not going to get that. In fact, if I were to draw a line even coming off of this initial low point here, where the VIX was relatively high, up to here, and then cancel that extension and duplicate that drawing. So if we were to have that same trend line, then that would be the move that we're going to get, that same move. So, and that's not going to happen either. So we're not going to get either one of these 2 moves coming off of this low over the next little bit. It's going to more look like this. This is the current 1 standard deviation, the current volatility, and what it suggests on the upper end of where the standard deviation is. So that's a lot smoother line than what we see. And then as the VIX gets lower and lower, then the VIX gets lower and lower, the trend line will get smoother and smoother. Obviously, the MACD and stochastics are slowing down with this near-term decline, but we're still easily above. We're still easily above the moving averages, and the moving averages themselves are getting into bullish zones. So that's a good sign. It's one thing for the blue line to cross above 0 and then come back down, or cross above 0 and come back down. It's not too often, as you see here. Here, let's go back 5 years, where the moving average for the blue line runs up. Here we had that last stage where it dipped a little bit above and then it came back down, then went right back up. That's kind of actually normal for the beginning, but we've already had that move, right? And so now we're if we get something like that again, it would be just a small hiccup before we continue the trend higher. You can see other examples over there of when we come from these low levels. We typically, the orange line, the blue line might not go straight up, but the orange line goes straight through that 0 level all the way up. So that's the expectation. That's the expectation there for this blue line here going forward. And then let's see here. All right, now we take a look at the intraday and look again, small range, pretty much the same range we had yesterday, and finish right smack dab in the middle of the range. And we did finish up above last week's high point, so as big as that range was, which essentially last week's range is pretty much the last week's range is pretty much the 4-week range, right? A little bit more of a, the high went up a little bit today on Tuesday's opening, and then we came back down and went sideways the rest of the week. But we did finish up above last week's close, and we are well up above here. And if I were to go back to that Hakinyashi, this is kind of give you an idea of how far we can come down and still be bullish. If you take a look at this Hakinyashi candle to kind of get an idea of where the next Hakinyashi open will be, we're looking at 289.46 minus 281.80. Whoops. Sorry about that. Fat fingered that one. 289.46 minus 281.80. Add that to 281.80. So we're looking at 285.63 is where this purple line is going to be. 285.63. So that's how far down we can come next week and still be bullish, right? But still not form a transition bullish candle, which, again, go back to the Heikin-Ashi here. It is better for us to continue to move higher, but you can see even in bullish moves, you can still get transition candles, right? Even after we've had the decline and then the bounce and the transition and then the bounce, we can still get a transition candle or two before we really take off. And that was this was the other time where the orange line in the MACD, its moving average got up a little bit above zero and pulled back down. Then we took off, right? So, don't be surprised if that's something that happens here. But, even then, there's your intermediate run there, and then there's the next intermediate run there. The volume is really tapering off, and the trading ranges for that matter. But the volume, again, 52 million, and then you have the trading range here. You have the trading range a half of the average. So when you look at that in context, the trading range is bringing this line down, bringing that back below 1. Getting back below 1 is another one of those signs that the train's leaving the station. And then the volume, again, well below the average. And again, it can stay down really low for a long time. So just don't think because it's low that it has to go right back up. Usually doesn't stay up for very long. Usually gets up to a point and then rolls over. Once it rolls over, it usually comes right back down. So when it comes down and gets to a low point, it usually will stay at a low point. So we are working our way back to the 52-week lows for this average for the volume. And then finally, look at the volatility. That last sign that this train's leaving the station there is to get this below 90%. So we're in the neutral range. It's about as neutral a week as you can get. And volatility is telling us that too. But, we're working our way towards the area where you break down, and then now we're bullish. Right now the train's going. And as I mentioned before, from a Bollinger Band standpoint, we need to really get above this 292.5 level, which is where the top end of the value area is. Get above 292.5 and away we go. And if you look at it from not McClellan oscillator. If you look at it from the Ichimoku cloud down here, Ichimoku cloud, 292. So right here, so getting it to 292.5 would get us through the cloud, easily above the cloud, and would start to get both of these lines through the cloud too. So that might not happen this week. We might be kind of stuck around here while these two lines are working their way through. But then you can see as the cloud here gets lower, it becomes easier to break through. And then we'll probably start to break through this again. There's where 292.5 is right there. Break through that either by the end of next week or early the week after. Then we'll be breaking out, right? Then we got the extended near intermediate run. We're not going to go up hard. So again, a reminder: once we break above 292.50, that expectation that we do break above 292.50. See, where was that chart that I showed you? Was it here? There they are. So remember, we break above 292.50. It's not going to look like these two lines, right? This one was a replicate of this move. This line was a replication of that move, a duplicate of that move over there. It's going to be more like this is what the volatility is currently telling us. So you can see even that's telling us that we'll probably get above 292. Well, here you can look at it better here on SPY. But if I were to draw the line at current volatility levels for a 1 standard deviation move, so right about there, all the way up to a July expiration, that we'll probably get above 292 right around late next week, early the week after that, most likely, if we continue to be as grinding as we are right now. Of course, summarizing here, of course, if there's any kind of trade issue or now, any issues with Iran over the weekend and the market tanks, don't comment on the video and say, hey, you said that the market was going to grind higher until the end of next week and then we're going to break out, right? Because news can throw all this out the window. This is what we expect, but things can happen the market doesn't expect, that can be announced and change those expectations or change the price patterns which impact your expectations. So until then, we can't not have any expectations, right? We have to base what we expect to see on what we do see and what we how we've seen it behave in the past with these current patterns, and we go from there. So that being said, what do you think? Do you agree or disagree with that outlook that we came up with today? I want to see you vote or see your vote. Click that link right there, so popping out top right corner of your screen, opens up that poll, and then vote with either agree or disagree. If you click disagree, scroll to the bottom to the comment section and share what you see that either tells me that you do expect a steeper climb through this resistance area, or that you're expecting a much bigger decline. And share what you're seeing that would tell you to expect that down in the comment section below. All right, let's get back to the charts here and take a look at what's driving price action today. So let's take a look at the different asset classes, and we'll take a look at just this week. So let's come over here, make it easier to get to. There we go. Just this week, and you can see it was a good week for agricultural commodities. Obviously, the crops in the U.S. with the storms in the Midwest and the flooding are impacting that, but so is the tariffs, right? There is expectations that things won't be as bad tariff wise, at least as bad as it seems, according to DBA, which has been impacted the most. Emerging markets had a really good start to the week, and then they kind of lagged behind. And the reason why? Because the dollar had a strong week this week. The dollar kind of had a little breakdown last week below support, and now it's a little bit of a return move back to the upside. You'll see that here in just a second. And that's had its impact on a lot of things, especially international stocks. They both were actually down for the week, as well as foreign bonds. Long-term bonds were also down. They started the week down. They rallied by the end of the week, but they started the week down. Gold started the week down too, and despite the dollar rising, gold rallied as well. And then finally, one thing that hampered risk appetite and just in general was crude oil. Crude oil at one point in time was down 5.5% for the week on Wednesday early. And then Thursday we bounced right back up, and then finishing down 2.6%. So if we take a look at some of the charts here for that dollar index, you can see the break back up above that line today. So a big breakout move back to 97.5. That was a level we had been watching before. We had broken back down below. So we'll see, how likely that is to stay. Look, it brought the near-term line up into the reversal zone, which is actually pretty bullish, and brought the intermediate line out of the lower reversal zone. So we'll see how long that's likely to stay. We used to have a red line, but we have light green shading now, so we don't have that bearish posture anymore. You can see it didn't quite have the impact on gold, but look at that long upper shadow on gold. So suggesting we might get some weakness again. It's okay if we get weakness because we are way up above the moving average, and that's what happens. But the trend is, the posture is still bullish here, even with it coming down. Now, it gets below 80, we'll get some light pink shading. But light pink shading doesn't change the trend. It's the dark pink shading with the red line that changes the trend. We're not anywhere near a red line on that either. And then finally, let's take a look at crude oil. Crude oil, I told you before, had this bullish divergence setting up here on the near-term line, on the higher lows in the blue line with the lower lows in the index. 55 is a key level there. So nice, good bullish close at the end of the week after Wednesday's steep decline to the divergent low point. Now we'll see, will that divergent low point lead to a new bullish trend? And if we do, it's got to get above 55. That's when, if it gets above 55, that's when you're going to be like, okay, here we go. We are now turning this trend around. If it stays below 55, then we're still going to be bearish on crude oil. And this is also a reflection of global trade, the impact of crude oil. But you see, today was the best performing outside of the dollar. Today, crude oil was, even though it had a small move, it was the best performing asset class. Do also want to take a quick look at TNX and continuing to get oversold clusters. And I mentioned before, it's rare to get, weekly clusters, much less a couple of them, usually lead to a bounce. Well, now we've gotten 1, 2, 3, 4, 5, 6. We got 5 in a row, and coming after those 3 in a row, And just for some context here, on and getting that many clusters back to back to back, we're looking at like 2007, October of 2007. Again, that was when the Fed was rate cutting, right? In September '07, that was the first time the Fed cut rates. So we were on a pretty steep decline, and we went all the way from 5.25%, which is where the overnight rate was, all the way down to 3.5% by the time the trend was, the intermediate run was done. Here it's a little different because we're not so high, but we've gone from 3.25%, which is well above where the Fed funds rate was, and now we're well below it, down to 2.09, and that's again a function of falling inflation expectations. And in fact, this doesn't update because it comes from the St. Louis database. But there are some reports out today that today's result has dropped all the way down to 1.5%. So that's a pretty steep decline. So I don't know if it's fallen that far. We'll see how far it actually has come down. But for yesterday's value, we're at 1.85. So that's pretty low. Again, the Fed raised rates when we were the inflation expectations were already down to 2% from 2.25%, and the Fed raised rates anyway. So now we're even, another 25 basis points below that. So again, hence the reason why the Fed here, whoops, not that one, it's this one over here. Hence the reason why the Fed is widely expected to cut rates, not because we are close to all-time highs, and usually when the Fed cuts rates close to all-time highs, 2007's started a bearish decline, but we also had a real estate bubble that preceded that. All the other, according to Ryan Dietrich's research, all the other rate cuts, including 1995, have actually been really bullish for the markets when you had that first rate cut. So the key is to have an extended rate cut, and the market's not expecting extended rate cuts. You still got you're about a 75% chance we'll get a third rate cut by next April. So that's actually jumped up a little bit. When you add these numbers together, you got about 3 and 4 chance that by next April. So we got a pretty decent chance we'll get one in July, and a really good chance we'll get 2 by the end of December. But then after that, the odds of a third one are high, but they're not baked into the cake, right? It's not basically expected. If we don't get one, the market's going to tank. Right now, if we don't get a rate cut, at least by September, where the odds are 96%, then the market's going to tank big time. So the market's going to be very, very keen next week when the Fed meets on their statement. You can see the calendar today. You had some pretty, actually decent economic indicators out today. Retail sales, the year-over-year rates coming down. But it was a relatively strong number compared to the previous month-over-month change. Not as strong as expected. Industrial production, you can also see its year-over-year rate. That's the rate we've been watching. Has been falling, but look at that nice strong bounce in industrial production. As a result of that retail sales and industrial production, you can see the GDP estimate has jumped up. So, early May, the GDP estimate for Q2 was below 1%, 0.9. It's jumped up, and now it's above 2%. So, maybe we'll still have that's still a smaller number than Q1 and Q4, but maybe we won't have quite the slowdown as we expect. We've had the slowdown, maybe we are bottoming out there. All right, if I take a look now, so this was a pretty busy week this week. If you take a look at the calendar next week, of course, the biggest news on the calendar is on Wednesday, the FOMC meeting, their press conference, their forecast that they come out with, because it is June, so they'll come out with that. You have the Empire State Manufacturing on Monday. It's a kind of a manufacturing survey, soft data point, because it's a survey. Housing starts by the end of the week. You have the Philly Fed, which is also another manufacturing survey, and then existing home sales by the end of the week. So housing's got a busy week this week. Manufacturing's got the two biggest, aside from the Chicago PMI, the two biggest regional surveys. And then, of course, the big one is on Wednesday, the FOMC meeting. From an earnings calendar standpoint, next week is relatively light. You can see the biggest names. I kind of look at the 4 billion mark as a threshold. You can see Jabil Circuits On Tuesday, on Wednesday, you have what was it? The Oracle. Oracle is due out on Wednesday. That's a big tech name, of course. Then on Thursday, we have quite a few more. You have Red Hat, Kroger and Darden, and Canopy is something that a lot of people have been focused on here lately. Still with no earnings quite yet, still negative earnings. And then finally, you have CarMax on Friday. So those are the main names. Very, very light calendar, but you can see focus kind of on some on technology, number one, as well as on some discretionary names, number two. All right, we'll take a look at the sector rotation and see how they have performed here over this week. You can see we go to 610. We'll go 10 minutes here. And you can see a very, very good week for consumer discretionary stocks. They rallied up over 2%, even though the market was only up 0.5%. Consumer discretionary was up. Interestingly enough, all the other safe havens had the best week here. Discretionary services, communication services. Remember, there's a utility type element to that as well. You have utilities there, and then there's staples and real estate. Those are all your sectors that outperformed. Materials, financials, healthcare, technology, industrials, energy, all lagging behind. So more cyclical areas. Remember, healthcare has got a dual function as well. They're all lagging behind. So outside of consumer discretionary, this is a really, really good week for consumer discretionary. All right, here's the consumer discretionary services sector and some of the names that are in there and the ones that had the best weeks this week. And you can see some retailers up here, Dollar Tree, Williams-Sonoma, Macy's. These are all companies that at least $20 that have the market cap over $4 billion. Home Depot as well. I mean, look at most everything is up. Remember, the market was only up 0.5%. So there's pretty much the break point. And you can see a lot of the names over here on the left. Amazon, the big one. There's your biggest market cap. So if you were to do this market cap weighted, Amazon had a good week. Alibaba had a good week. Home Depot, strong week. Not so good for McDonald's or Nike, but Starbucks, Lowe's, Sony had a really good week. Pretty market matching week on General Motors. Las Vegas Sands and Target both had strong weeks. Tesla had a bounce back up here. There's a few other names. eBay, Dollar Tree up 7% this week. So you can kind of get an idea of why. There's your housing kind of lagging the market just a little bit there. Best Buy. So a bunch of retailers and e-tailers all having really strong weeks. Lululemon right there, 2.5%, and outpacing the market. So strong week for financial. Now remember, if I were to go back here and go, over the last 200 days in terms of how bullish we are or not, right? So because you had this strong week in the staples and how. Let's go to 2018 here. Sorry, so August. And then 28, and then 2018, and we'll go to a daily chart. So again, the last 200 days, you can see the strong rally. Again, the broad market itself is flat. It's actually down a little bit for the week, and those three areas themselves still are showing just tremendous double-digit gains over that time frame. So again, not the most bearish of patterns, right? Usually the more bearish we are, for an example, the kind of comparison in terms of like expecting to be bearish going forward, if I were to look at, right before the market peaked here last year, give me 1 second, move that over, last year, right before the market peaked, right about October the 3rd it was. So a lot of these were on the flip side. So let's go back to the 200-day period. Nope, not that one, not that one. I always hit the wrong ones. So we go back to December the 18th of 2017, all the way up to October the 3rd, before the market started to drop in the end of last year. So you can see the broad market over that period was up 9%. And the biggest winners there was technology and discretionary. You see energy and healthcare doing really well. Industrials lagging behind, and then all your safe havens. This is the chart that preceded that weakness, right? This is the chart that in fact, here, let's do this really quick. Okay, so I mentioned August 20. Sorry about that. Okay, good. So I mentioned August 28th started that 200-day period that we're in right now. With staples and utilities and real estate lagging. This is the 200-day period that ended on August the 28th. So August 28th being the inflection point, right? That was 200 days ago. So you can see the market, has only been flat and the 200 days since the day here on the right, with the safe haven areas doing the very best. So you can see how they were doing the worst, and they were still doing the worst by the end of that period. And these were doing the best, and they flip-flopped. The market was up 12% over that period, and now it's only up 0.5%. So you can see the difference now when we say, okay, that pattern looks a lot more bearish going forward 200 days from that day than this pattern does, right? This pattern, when you go to August 28th till now, here, and then go to today on this one, and go to a daily chart again. See, that's a much different looking chart. And this one's not as bearish going forward from today. Obviously, it reflects a lot more volatility that we've had since that August 28th period. But that's all in the past, right? We can't go back and now trade August 28th. We have to trade June 14th over the next 200 days. So what do we expect this chart to look like 200 days from now? Well, according to the rotation, you would expect a pretty decent move on S&P. Maybe not 12%, but you expect a pretty decent move to the upside, and you expect these areas to be the losers to the downside. Interestingly enough, again, this is the period that ended, the 200-day period that ended that that November 2017. So in this period, from 200 days from this day going forward, we had a really good bullish pattern. The cyclical areas led the way. The safe havens really came in behind. Well, you can see the weakness in the safe havens was starting. Utilities still outpacing heading into November. Real estate was just right behind the markets. It had a period of weak performance right in here in kind of fall of 2017. Until then, they had pretty good runs, and of course, energy lagging behind. So that's the pattern that we had going into. So you see again. Just a reminder that, this pattern here is a reflection of, and let's go August 28th of 18 till today. This pattern here is a reflection of the volatility that we've had and the relative bearishness that we've had, being down over a 200-day period. It is not a reflection of bearishness expected going forward 200 days from now. We expect things to look a lot different. Now they might, maybe one of these will come down, or two of them, and one will stay up. Maybe energy's been really weak for quite a while. We don't know what it's going to look like 200 days from now, but it's not going to look like this. I think a lot of people think, well, it looks like this now, then this is how we should trade going forward. And the reality is that's what it looked like here, because over here, the 200-day period that ended there was very bullish, right? We had cyclicals way outperforming the market itself, up 12.5%. So we were really bullish, and that eventually led to this longer period of volatility and consolidation. All right, what are one of the stocks? What are some stocks that could be doing well 200 days from now? Maybe CF. You can see CF, which has pulled back from 55 all the way down to 40. Has kind of based with a little bit of a triple or head and shoulders bottom, inverted head and shoulders bottom, and then to this week's breakout, big time breakout this week, getting above here. You can see that it's green line here crossing above the blue line in the Ichimoku cloud, not quite above. It's not on the bullish trend yet, but you can see the breakout pattern in the inverted head and shoulders pattern. In fact, if you take a look at its Bollinger Bands here, you can see, breaking through a lot of volume with this week's move and getting up to the upside. Could this be a long-term play? We could look at buying the stock $46. We could also look at buying an option that's got 200 days out to expiration. So if we were looking at buying the January 20 of 1720 and just buying the at-the-money option, so instead of paying $46, I'll pay $4 per share. It's got a relatively wide spread, 15 cents, so it's not quite 10%. It's not even 5%, but But it's relatively widespread. But remember, we have a long time on this, considering let's see how CF could trade between now and 217 days from now, according to its current volatility levels. You're looking at a move potentially up to say 57 in the third. So just to kind of give you an idea of what that option could do if it were to get up there to 57 in the third. Let's see here. It'd be another $11.35 or so. So if it does get up there with no change in volatility, assuming no change, obviously there might be some change, but that option would double in value at $4.20 all the way up to $9.85. And obviously if it goes up more, then if it goes up 2 standard deviations, see 57.5 would be right up to basically the 52-week high. Getting through that, getting through that with a 2 standard deviation move. Now you can see, or anywhere in between, you can see the potential a stock can have like that. So we can sell that, or we can even go further in the money. So you know what? Let's do a higher probability trade since that's at the money. Let's treat this like the stock option. So let's go here to a stock, like a stock, and let's buy in the money. Now it's a little more expensive. It's twice as expensive. $8.45. You can see the same move would also double my money, essentially from $8.45 up to $17.35. But here's the difference. We can buy the $40 call, so it's already in the money, whereas this was a little bit out of the money. We can buy the $40 call. Then we can say, you know what? Let's come over here to the July expiration and let's sell a covered call on this. So it ends up being a diagonal spread. You have a long call at 40 on that January, and remember we spent $8 and some odd cents on it, and we're going to recover $1.25 of that cost with this, or excuse me, $1.22. We're going to recover $1.22 of that cost with this call. And if we go above 47.5, we can roll that option from 1 month to the next. But we can try to start to recover some of that $8 with this. And you've got July, August, September, October, November, December, all the way to the point where you get to January. And if we do take off and this gets to a high delta, we can lock in some of that credit as well by buying back or selling the call option at the higher deltas and then rolling it back down towards the 70 and locking in with the credit you receive there. You can lock in some gains. So a lot of flexibility that you have when you, instead of buying the stock expecting a longer term return, you can instead buy the long term call option and then sell calls against it going forward. Okay, as always, that does us for today. Again, I appreciate you watching our video today. Now I want to hear from you. So there's that link popping out right there that goes to our forums. Open up any new thread you want there with, remember you have to subscribe first, but you can do that for free, and then open up any new thread with any questions or comments about the video that you want to keep this conversation going with other market scholars as well. Remember, you can reply to other people's threads that you see in the same forum. So let's keep that conversation going here. Again, remember to subscribe to our YouTube channel, hit that thumbs up icon to comment on the video, follow me on Twitter for more content in between videos, and then join our daily Market Outlook email list as I showed you there before. Thank you very, very much for watching. Have a great rest of your weekend. Happy Father's Day to all those fathers out there watching. We appreciate you, and we'll see you all on Monday.